You've probably seen the term quant thrown around on Twitter or Reddit, sometimes with guys flexing about insane salaries or algorithmic trading like it's some secret Wall Street club. But what the hell is a quant, really? Are they math geeks, finance bros, robots, or something else entirely? And why do people joke that it's math plus autism plus finance? In this video, we're going to unpack what a quant actually does, how this world works, and what the stereotypes miss. By the end, you'll understand the real meat behind the buzzwords and why quant finance is one of the most competitive, misunderstood, and fascinating corners of modern markets. Let's dive in. What quant actually means first? Let's clear the basics. Quant stands for quantitative analyst, a finance professional who uses mathematics, statistics, and computer programming to analyze financial markets and make decisions from data. It's not short for quantum, and it's not some secret code for finance bros. It's about numbers, models, and logic. Quants show up most commonly in hedge funds, investment banks, asset managers, and trading firms. Their job is to build mathematical models that help price assets, manage risk, and sometimes automate trading. Think of them as the engineers of finance. Instead of listening to gut feelings, they rely on data and models to guide decisions. If a stock moves up or down, a traditional analyst might look at earnings reports or industry trends. A quant asks, can we express that behavior with equations? What does the data say when we run simulations? That's the fundamental difference. The tools of the trade. So what do quants actually use to do their work? At the core are mathematics and statistics, calculus, linear algebra, probability, stochastic processes. These help quants build models that estimate prices or measure risk. Then there's programming. Languages like Python, R, C++, and MATLAB are staples. Quants write code to process massive data sets, test models, and automate strategies. Without code, the math stays theoretical. Modern quant roles often involve machine learning too. That's where AI helps find patterns in data humans might miss. Some firms are even exploring autonomous systems that can generate trading ideas without humans guiding every step. It's a mix of hardcore math and hardcore tech. What quants do. Day-to-day quants don't all do the same thing. There are different roles. Quantitative traders design and implement trading strategies that operate on rules or algorithms. These can run in milliseconds or over longer time frames. Their goal is to capture small, consistent profits using data patterns. Quantitative researchers focus more on the theory, building statistical models that predict market behavior or price derivatives. They explore new ideas and test their validity. Quant developers build the software infrastructure that makes everything run. They bridge finance and engineering. Risk quants analyze and control risk exposure for portfolios, ensuring models account for market stress and volatility. So, a day could involve anything from writing Python scripts, testing a model's accuracy, tweaking algorithm parameters, or even meeting with traders and portfolio managers to tailor a strategy. It's not suits and hustle culture like you see in movies. It's data, models, simulations, and debugging. Why quant jobs pay so much now? Let's talk money. One reason the quant world gets so much hype is the compensation. The work is hard, the skills are rare, and the financial rewards are high. In some interviews and reports, traders have claimed monthly earnings that make average salaries look tiny by comparison. Why so high? Because even a small improvement in a trading model can lead to huge gains when applied at scale. A model that's 1% better than the competition can translate to millions in profit over time. Keep in mind that not all quant roles are trading roles, and compensation varies widely based on location, experience, and performance. But the potential upside is one reason talent from physics, engineering, and computer science floods into quant finance. The stereotype: math plus autism plus finance. This part needs context. On Reddit and in casual chats, You'll see people joking that being a quant is math plus autism plus finance. That's a stereotype rooted in the idea that quants are extreme nerds who think in numbers and lack social polish. Here's the important clarification. Autism is a neurodevelopmental condition, and reducing it to shorthand for nerdiness or social awkwardness is inaccurate and insensitive. What's true is that the quant field attracts people who enjoy deep analytical thinking, complex problem solving, and working with abstract systems. That doesn't mean quants are autistic, and it doesn't define their social skills or personalities. So when you see that phrase online, recognize it as internet humor that mixes admiration for analytical skills with a stereotype. The real takeaway should be that the work requires a strong quantitative mindset and comfort with deep technical challenges, not any specific personality trait. How quants are changing finance today? Quant methods drive more of the financial industry than ever before. Hedge funds like Renaissance Technologies, Two Sigma, and Citadel use data-driven models to guide large portions of their trading. Quant strategies consistently grew over the past decades and now power not just trading but risk management and portfolio construction at major institutions. AI is accelerating this change. Competitions like World Quant's International Quant Championship have drawn tens of thousands of participants, with AI tools making strategy development more accessible, lowering barriers for students and new talent. In cities like London and New York, quant firms are now among the most profitable financial players. Some have reported multi-billion-dollar revenues, competing with traditional trading desks and reshaping where capital flows in global markets. So quant finance isn't some fringe corner of Wall Street. It's a core driver of how modern markets operate. What it takes to become a quant. If someone watching wants to know how to break in, this is the reality. Most quants have strong backgrounds in STEM fields: physics, mathematics, computer science, engineering, or statistics. A master's or PhD isn't always mandatory, but it helps. You should be comfortable with advanced math programming, especially Python and numerical libraries, statistical modeling, data analysis, financial concepts. Many people also participate in coding challenges, math competitions, or specialized quant boot camps to build skills. It's competitive, and often the earlier you start building these skills, the better. Some people try to pivot from other careers later, but it's generally tough because the learning curve is steep. The culture and misconceptions. There's a lot of mystique around quants, like they're hidden geniuses sitting in dim server rooms with monitors full of code. In reality, it's just a specialized career path where logical thinking, technical skill, and persistence matter. The culture varies by firm. Some are formal and corporate, others are laid back and engineering focused. One big misconception is that quants only do trading. In truth, many work in risk management, regulatory reporting, technology development, or even in fields outside finance like insurance and consulting, because the same analytical skills are valuable everywhere. Another myth is that being a quant means you're socially awkward or isolated. People with all kinds of personalities work in these roles. It's a job, not a personality test. If you liked this video, hit subscribe for more deep dives into the finance world. Drop a comment if you want breakdowns of other confusing finance terms. Thanks for watching.